Welcome back to What's Hot, What's Not, CRE. It's Wednesday, April 1st, 2026, and today we're breaking down the 10-year Treasury and what it signals for commercial real estate. Let's start with what's hot. The 10-year Treasury eased to 4.28% today, down 4 basis points from yesterday, and down a significant 53 basis points over the past week. After climbing to 4.44% on March 27th, yields have pulled back sharply. This is welcome relief for CRE investors who've been watching rates very, very closely. Also hot, deal velocity is picking up. Q1 2026 transaction volume is projected to exceed $66 billion across the 4 major asset classes, a marginal improvement from Q1 2025. The Southeast is outperforming, with transaction dollar volume up 26% year over year. Charlotte and Jacksonville are leading the charge on favorable demographics and economic trends. Lending spreads are tightening. Low-leverage multifamily and industrial spreads have compressed to between 115 and 125 basis points. Agency multifamily rates are currently running 5.42% to 5.59%, depending on the term. We're seeing capital allocations increasing across life companies, and banks are actively competing for stabilized assets. And finally, cap rate compression is beginning to take hold. The industrial and multifamily sectors have already seen compression, especially for high-quality Class A assets. CoStar projects that yields will continue to ease across CRE property types as financing conditions stabilize. Now, for what's not. The Fed is on hold and may stay there for a while. The FOMC held the federal funds rate steady at 3.50% to 3.75% at its March meeting. The dot plot signals just one 25 basis point cut in 2026, and some analysts, including JP Morgan, expect no cuts at all this year. Sticky inflation and geopolitical risk from the Iran conflict are keeping the Fed cautious. The wall of maturities is here. It's not coming, it's here. Approximately $1.8 trillion in commercial loans mature in 2026. Many borrowers are facing significant refinancing challenges: higher insurance premiums, lower NOI, rising property taxes, and increased operating costs. The office CMBS delinquency rate hit 12.34% in January, an all-time high, and longer-term rates remain elevated. The MBA forecasts the 10-year Treasury will average 4.2% for 2026. Fiscal deficits and a national debt exceeding 100% of GDP are putting structural upward pressure on yields. Don't expect a return to sub-4% rates anytime soon. So why does all this matter? The 10-year at 4.28% is approaching the sweet spot for CRE deal flow. That 4.0% to 4.25% range, where cap rate spreads work and transactions can actually pencil. The weekly pullback from 4.44% is encouraging, but we need sustained stability to unlock more capital. The Fed's cautious stance means any rate relief will be gradual, not dramatic. Your investor takeaway: lock in financing now while spreads are tight. The 4.28% yield is workable for quality assets. Focus on multifamily and industrial where cap rate compression is already underway. And avoid assets with near-term maturities and weak fundamentals. The refinancing environment remains incredibly challenging. Stability is the new catalyst. That's your rates update. Thanks for tuning in. Don't forget to like, share, and subscribe. Visit hotnotcre.com to learn more and subscribe to our newsletter.